Look, the bottom line is the old Nasdaq playbook doesn't work anymore, period. And if anybody tells you that it does, you should run the other way. Have you ever wondered what's really happening inside the microcap markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Microcap Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman. Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most committed and ambitious entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or operating inside the emerging growth ecosystem, this briefing is for you. My goal is simple: to give you a clear, real-time view of what's happening inside the microcap markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings to reverse mergers, SPACs, secondary offerings, and the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
I'm Caroline, and welcome to Inside the Microcap Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the microcap ecosystem and break them down in a live question and answer format for Joe to give you his take from the trenches. Before we jump into today's questions, Joe, can you give us a quick read on what you're seeing out there right now?
Yeah, so right now it's a very interesting time, Caroline, to be in the microcap landscape. I mean, on the surface, it feels like the market is open. There's activity and, companies are making filings. People are really working on things. But underneath all of it, it's a very different environment than even 6 months ago. There's more scrutiny on deals, there's more selectivity in the deals, and obviously a lot more discretion exercised by the exchanges in these deals. And really, the deals themselves are taking longer to get through the listing process. So things are happening. They're just not happening the way people would expect or really would like them to happen.
Thank you for that overview, Joe. So now we're going to get into the questions we have for today. And just to level set here, everybody, these are real questions coming out of the market right now from companies, boards, bankers, and even live deals. So if you've got a question, please send them to us at questions@lucbro.com. That's questions at lucbro.com. And it might be covered on a future episode. All right, Joe, we've been hearing this a lot, and I know you've been getting this question constantly, but what's really been going on over at Nasdaq these last few months?
Yeah, so Caroline, it's been a really chaotic last 3 months over really at both exchanges, but especially Nasdaq. And I know it feels like a slowdown in the marketplace, but the reality is it's not that simple, because what's actually changed is Nasdaq has moved from a mainly rules-based system over many, many years to a completely discretionary one as of December 2025. It used to be that if you hit your numbers in a listing application, meaning you had $5 million of shareholders' equity or $15 million of public float or the right amount of shareholders, that, you could really see a direct line to listing. Now, that's really just the starting point for every company.
So you're saying that this isn't just a slowdown in the microcap markets, but this is actually Nasdaq raising the bar and rewriting the listing process.
Yeah, exactly. I mean, this is really a filter, not like the pause of 2022 in August, where Nasdaq literally shut down the entire microcap market for about 60 days. This time, the market isn't closing or closed. It's just being so much more selective. And the companies that can't meet the higher bar or get through the discretionary review, well, they're not going to get through the process anymore. And candidly, the same thing is true for bankers and advisors. If your deal team can't understand how this process really works today, then you're not going to get listed.
So, Joe, when you say discretionary review, what does that really mean in practice, and what are they actually looking at?
That's the part I think most people don't fully realize that's going on in the marketplace right now. The exchanges are not just looking at the company anymore. They're looking at everything in and around the company. I mean, management teams, cap tables, jurisdictions, where your board is located, and most importantly, who your bankers are, who your advisors are, really the whole structural picture of a company looking to list on Nasdaq. And here's the real question that they're asking now on every deal. Does this deal belong in the market? And more importantly, does this deal belong on our exchange? That's a very, very different standard than from years past.
Yeah, that's a great point, Joe. Can you give us an example of what that looks like in the real world?
Yeah, I mean, we saw it firsthand when we did the Rock AI deal this February 2026, the Rank 1 computing deal, which, by the way, was the first microcap IPO of 2026 on Nasdaq after a 78-day microcap IPO drought. And that deal didn't get done because we met the quantitative listing requirements or because the company completed an application or checked some boxes. That deal got done because it held up under real scrutiny by the exchange under the new rules, and we understood what Nasdaq was really looking for to get that deal across the finish line. And I'll also say that it was a really good domestic company with a highly credible management team. And another factor that I think really was in the favor of Rock AI was that they raised $24 million with Benchmark Capital, which is a very healthy number for a microcap company and a microcap deal. The bank had real distribution. They had very little concentration. I mean, really, Benchmark did a phenomenal job on that deal. And that's the real shift that most people don't understand right now in the marketplace. There are no more easy cookie cutter deals.
So, what exactly does that mean for the founders and boards who are thinking about going public right now and are already in the middle of a process?
Look, the bottom line is the old Nasdaq playbook doesn't work anymore, period. And if anybody tells you that it does, you should run the other way. And I'll tell you something else. A lot of people, especially some bankers, other lawyers, consultants, and advisors that we interact with, they're still acting like it's 2021 or even 2025. And I can tell you it's not.
Okay, so then what part of the old playbook do you think is breaking down the most?
Well, it's not just a discretionary review. It's really how the entire deal is now evaluated within the exchange. I mean, everything has to really work together. Your company, your deal structure, your distribution, your bankers, your advisors. I mean, the list really goes on and on and on. These are no longer standalone pieces anymore if you want to get cleared on NASDAQ. If your deal is too concentrated or your distribution isn't right or your structure doesn't make sense, that all feeds into the same decision.
So, are you saying that the real issue is that too many deals are still being run in silos or just under the old playbook?
Yeah, I think, what people are missing in the marketplace is that too many deals are still being run in silos, thinking that they're going to clear the listing process. I mean, bankers are doing one thing, lawyers do another, they're focused on other things, and really nobody is quarterbacking the full picture to be an advocate for the company to get through the listing process. So the bottom line in my book is that this is not a checklist exercise anymore with the exchanges. It's really about whether your deal can hold up under intense scrutiny that is both objective and subjective under the new discretionary rules. And most importantly, who is going to communicate that to the exchanges? Who is your advocate? Because there are very few people that can do that, in my opinion.
Okay, and just to follow up on that point, are there still some companies and even some advisors walking into this thinking that their company will just hit the numbers and they'll be fine?
Exactly. I mean, that's exactly what we hear from some founders, bankers, some companies, but that's also exactly where this process is going to break down. A lot of teams are still building towards those minimum thresholds that we talked about earlier, and that used to work in the past. They're saying things like equity and the flow and these basic metrics, but the minimum thresholds, they don't get deals done anymore. They're just one part of the process. And frankly, it's the least important part of the process in this moment in time. That's the old market. That's the old NASDAQ. Now you need not only the right company, but the right team, the right credibility, and most importantly, the right deal structure that can withstand intense scrutiny. So if you don't have that, it's going to come up during the review process. And by then, it's much, much harder to fix.
All right, thank you, Joe. So that leads us to the next part of our conversation. If you're a founder, a board, or even a banker operating in this environment, what should you be doing right now?
Great question, Caroline, because I think about this all the time as an active capital markets lawyer. In my book, there are really a few things that every company that is serious about listing should be doing right now. The first thing I think is pretty obvious. You have to start the process earlier because the process is just taking longer. Now, that doesn't mean if you haven't started the process or if you're in the middle of the process that you're in trouble. It just means that if you have the advantage of time on your side, you should try to start the process a little bit earlier.
And what would you say is the biggest mistake that you see when people don't start early enough?
Well, they try to figure things out while they're going through the process, or they leave too many important things to the end. And in my opinion, that is really the kiss of death. You have to figure out early in the process, your structure, who your bankers are, who your advisors are. And by the way, are they credible enough to get through the process? What management team are you going to go public with, including your board of directors? And most importantly, what blind spots your deal may have, and fix them early before they even come up on a listing process or a Nasdaq radar. That all has to be figured out from the beginning. Gone are the days, Caroline, where you could add pieces of the puzzle along the way and be just fine. That playbook is over. I was telling someone the other day that in this current market environment, there are very few second chances. So make sure you clean up your deal and clean up any potential issues earlier in the process.
Yeah, that's a really great point. And what about the raise itself? Because a lot of these people still seem so focused on just getting to that minimum number.
Yes, sadly, that is still the case. And that's really the second thing here. Don't cut it too close. Just because NASDAQ or really the New York Stock Exchange may technically allow a $15 million minimum raise, that doesn't mean you should aim for a $15 million capital raise. A few years ago in 2022 and part of 2023, we used to say that less was more in the marketplace because deal amounts and volumes were down, and the market was really reacting better to smaller and tighter capital raises because at that time you really could register selling shareholders, combine that with the IPO proceeds, and achieve minimal listing standards. Well, you can't do that anymore. So that's all out the window. In my view, from the trenches, bigger is really better because it gives the exchanges more comfort that your deal is going to be better distributed, less concentrated, and ultimately perform better.
So basically, what you're saying is that people shouldn't be shooting for the minimum on these deals anymore. Is that right?
Yes, I mean, less is not more in this market, and you really shouldn't be shooting for the minimum qualifications on any deal. Now, remember, there's three components that are really, really important parts of the deal: your company qualification, your deal qualification, and most importantly now, your discretionary review. They all have to work together to achieve a successful listing outcome. If you're borderline in any one of these, meaning you're just cutting it too close, a minimum capital raise isn't going to carry you through or rule the day. You're not going to get listed. So, in my view, the strength and size of your deal matters and the structure matters. This market now is rewarding well built deals, not borderline cases that are trying to cut it too close.
And can you just tell us more about the team built around the company? I mean, how much does that really matter now?
It's huge. It's a huge part of the process. That's a third thing that I've been thinking about. You really have to build the right team. You need people who understand how NASDAQ and the NYSE are actually applying their rules today, not 1 year ago, not 5 years ago, not 20 years ago, especially on NASDAQ with these new discretionary standards. Not just what the rules say on paper, but how the exchanges are actually applying them to live deals in the trenches every day. You can no longer be an order taker or an information processor. Advisors who can't adapt, who are just processing information, they're not really helping their clients. They're going nowhere fast because the rules alone are not going to get you listed anymore.
So, bottom line, Joe, what do you really think is separating the deals that are getting through from the ones that aren't?
Well, the ones that get through are the ones that are built for this market, meaning they've taken the time to understand how the company actually qualifies, how the deal qualifies, and most importantly, how they are going to get through this subjective review standard. They're not trying to do the minimum. They're not cutting it too close or trying to sneak in under the wire the way some deals have, gotten through the process in the past. The deals that are getting done are the ones with stronger companies, cleaner structures, real capital behind them that, again, is not cutting it too close, credible advisors, and most importantly, a quarterback or a real advocate that can get that company across the finish line with the exchanges.
Okay, but what happens when that's not the case?
Well, if you have a weakness in your deal structure or in your company structure, that's going to get exposed. Unfortunately, it's probably going to get exposed much later in the process when it's too late. And that's a real problem because you can go down this road, spend a ton of time, money, resources, and then be told at the end that you can't list because you had a weak structure or a weak team or some other blind spot arise later in the process. Those deals that are trying to get through by squeaking through or cutting it too close, they're not getting done in this market. They're either built on bad advice or have a bad foundation, and they're going to get exposed much, much later in the process after, unfortunately, you probably spent way too much money.
Yeah, Joe, that's actually a great point. Can you just share a quick example of that?
Sure. So something happened to me last week. I got a call from a group in the industry that wanted to refer us a deal. And the company was based almost entirely in Asia. They had decent revenue, but not a tremendous amount. And their operations were concentrated mainly in China. The board was largely outside the United States, I think all but maybe one director, maybe two. And they had all these advisors around the company sort of lurking around and really couldn't articulate their role. Some of them, at least I thought, were, as we used to say, operating in the shadows. That deal is not getting through the process. I don't care what anybody says. It's not happening. Obviously, we didn't take the engagement, but at some point, you really have to be honest about where the market is and honest about whether you are ready to take that next step and get listed on a senior exchange. You can stay private. You could build your business. You can strengthen your foundation or your structure or upgrade your advisors. You can even go to the OTC if that feels more comfortable and then come back when you're really ready. But sneaking through the system or doing the minimum or cutting it too close, that is no longer a credible plan in this marketplace. And don't let anyone tell you otherwise.
All right, Joe. Thank you for sharing. We definitely covered a lot today, but from your perspective, what do you think the real takeaway from all of this is for everyone listening?
The takeaway is very simple, Caroline. The market isn't closed and it hasn't shut down like so many people have claimed it has. It's just upgrading. It's evolving. It's raising the bar for the entire ecosystem. And those founders and companies that understand that shift and prepare for it with the right advisors, and most importantly, the right quarterback, will get through the process.
You've been listening to Inside the Microcap Markets with Joseph Lucosky. For more insights from the trenches of the microcap markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@luckbro.com. That's questions@lucbro.com. Thank you for listening, and we look forward to next time.